So today we're going to talk about Treasury management from the perspective of the board of directors. This is the first part of a three-part course, and it's intended to help treasurers to make sure that they're able to do all the things that they need to be able to do within a board of directors. Somebody might be new to the role of treasury, or they might have been in the role for a while, and this is just meant to be a helpful refresher or to just at least give you some of our perspective on what we think would be the most effective way to manage an organization from a treasury perspective. The first course is going to be an introduction and an overview. We're going to talk through meeting cadence, reporting, and accrual versus cash accounting. Then we're going to go in the second course to more reporting in depth. And then for our third course, we're going to talk through taxes, compliance, and audits. A board is required to have a treasurer. Sometimes that role will sit with multiple people. They'll have the treasurer role won't sit with multiple people. They'll have one person filling multiple roles. They're typically always volunteers. They may or may not have any financial experience, and that's okay. Anybody who is willing to step in and take a look at the financials and to help bring that organization forward um, just needs to have a little bit of support, and they're able to make that organization very successful. The treasurer is responsible for the oversight of the internal accounting and financial processes of a organization. They're responsible for making sure that the money that they have, and that they're meeting their financial responsibilities. And they also sit on, typically as the head of the finance committee, which is a subcommittee of the board, which is there to help people. It's there to help the board of directors to be able to get all of the financial information from the company management. So first, I want to talk a little bit about a meeting cadence that we do for Treasury. So it's like I had talked before, a finance committee, that is a great structure to have. And that is a smaller group of board members. And usually what we do is have a meeting of the finance committee before the full board meeting. And at that meeting, somebody from the business is going to bring forward the financial information to the treasurer, and they're going to have a discussion about those financials. So inside that meeting, somebody will bring forward the reports. They'll typically send those reports out a few days or a week in advance so that the treasurer and the other finance committee members have an opportunity to read them. Then inside that call, there's going to be a deep dive into those reports. The finance committee is then able to ask all the questions that they want, and really get some comfort around that set of information in there. After that process is complete, sometimes there might be some more internal refinement that needs to happen on those numbers before it's ready for the board. But our objective is at the end of that meeting or shortly thereafter, the finance committee is now able to offer up a recommendation to the board to accept these financials. Now, I think one of the critical points to talk about here is the timing. We want to make sure that for example, if we're looking at the financials for the month of May, then we're going to have to give that internal accounting team some time to complete the May financials so that they can get it to the finance committee. So that finance committee meeting probably cannot be any earlier than about the 5th of the month, with a more comfortable timeline being somewhere around the 10th. Then they're able to have an opportunity to review those financials. And then by the 15th or so, you're ready to have the board meeting with that information ready. And then that would mean that the board on the 15th of June is looking at financials for May. So it's pretty close to as timely as information as you're likely to be able to get in these scenarios. So for the reporting, I think it's important to point out that we always want to start at the top of the data and work our way down with the numbers. Start with the very biggest numbers and the very biggest dollar figures that are showing up on those reports and always work your way down. There's the concept that something is much, the big numbers matter more than the small ones do. The small ones, of course, can matter too, but we want to start at the ones that are going to be the biggest impact to the organization. I think the few of the most impactful ones would be just the bottom line revenue figure on the statement of financial activity. So just taking a look at the bottom of that one and seeing, okay, how did we do? Okay, we were supposed to have 500,000 in revenue. How much revenue did we have? We had 500. Good. How much cost did we have? We had 400, which gives us the net of $100,000. And we can look at that across and compare it quite quickly to what it was supposed to be and what it was supposed to be and what was it last year and the year before. Comparisons and consistency are very important for us because that's how we're able to tell what something was supposed to be. If we could see that 100,000 was the number that it's been for a while, we can at least get the initial indicator that that number is probably okay. If we could see that it's way less or way more than it was before, then we know we need to dig deeper into that area. Consider these reports are going to have hundreds and hundreds, if not thousands, of figures on them. So we've got to get our eye trained to looking for the ones that matter the most. And the biggest pieces you're going to have with that are start with the top and work your way down in numbers. As you become comfortable with the big numbers, then keep moving your way down until you have comfort with more of the numbers on that document, and make sure to compare them. Compare them to last year, last quarter, last month, to the budgets. That's where you're going to get a lot of strength. We don't even know if 100,000 is a lot or a little unless we can see what it was before or what we're comparing it to. One thing I like to see when we're doing these reporting is just directly pull reports out of the accounting systems. We see a lot of times where internal accountants, by many times the request of the board or others, will heavily manipulate the reports that come out of the accounting systems to be able to meet objectives from the finance committee or the board treasurer. And what I would recommend is that we really teach the treasurers how to read the financial statements and the financial information that comes out, because that gives you a much stronger view of what's going on in the business and it eliminates a huge opportunity for errors. As soon as folks start taking numbers out of the accounting system, we really start asking for we're introducing a lot of opportunity for error, because now we're translating it. Double entry accounting is a beautifully robust system in and of itself. And once you learn how to look at the financial statements that come just directly natively out of every accounting system, you're able to see with pretty quick timing what the status is of that organization. That's not to say we're not going to want some sub reports and sub statements of activity, and you're not going to want to have drill down reports for things that might be important for a particular area. I can certainly see that. But I think the makes the most sense to start with the documents that they already produce. And there's of course going to be opportunities for improvement within those documents. There's opportunities for improvement everywhere, right? So they can likely, if the statement of financial position and the statement of activity are not translating at all to what the board needs to see, then maybe it's time to start renaming some accounts or reorganizing how those things look on there, so that they're clearer. The other thing that I really like to see when we pull these accounting reports is I want to see the reserve account directly highlighted on that statement of financial position. And ideally, we even see a subsequent bank statement that shows where that money is in there as well. Okay, the next thing we're going to talk about, and just as a note, we're going to talk about reporting in the next module of this course in great detail. That's all we're going to talk about is those reports, and I'm going to give you the high level view on how to look at those reports that you need to look at. So the next thing is accrual versus cash accounting. So there's two types of accounting that is used in any organization, not just not for profits, and one is cash and one is accrual. And cash accounting is where money that comes in, everything is recognized when it hits the bank. When money comes out of your account, that's when you recognize it as an expense. When money goes into your account, that's when you recognize it as revenue. This is the easiest style of accounting. It's very easy for many folks to wrap their heads around. And it's because it's easier, it requires less accounting staff, less complexities, and it is therefore less expensive on your organization. Every additional hour of time spent by an accountant, whether they're internal or external, costs the organization money. So we want to make sure we're spending that where we need it. The second type of accounting would be accrual accounting, or also called GAAP accounting for generally accepted accounting principles. This accounting system recognizes transactions when they occur, not necessarily when they hit the bank. So this means that we're accruing payrolls for money we know that we've spent, even though they're not necessarily going to pull it out of the bank quite yet. This is to do accrual accounting correctly is much more sophisticated and requires a specialized set of skills. Typically, this is where you're starting to bring in more of a controller style resource into the organization, and it can be very beneficial depending on what you're looking at. But it's also a lot of organizations I see struggle here because they're attempting to meet accrual accounting when they don't have the necessary skills to do that. And what they need to be focusing on is doing cash accounting because they can do cash accounting correct. In either of these methods, it can be highly secure. Either of them can be built out for strong internal controls. And it's just a matter of what your not for profit wants to use. Now, there are some times where these are a requirement. And I specifically bring this in because it's not always a requirement that we follow accrual accounting. This is a common misconception. I feel like we have this discussion with probably every not for profit that we talk about. So, just for starters, the IRS does not need you to do accrual accounting. And the IRS is one of your main regulators. Your other regulator would be the state. If you're in the state of California, once you reach 2 million in revenues every year is when you need to begin doing accrual accounting. In New York, it's 1 million. In Massachusetts, it's 500,000. And then in the states of Florida, Illinois, Georgia, and Michigan, they require based on donations. You have to hit a certain donation threshold, and they're pretty high donation thresholds. So it probably means that your organization is in the $3-4 million range. And so that's just a good consideration because we want to make sure that we're doing this when we need to. Once we hit these higher thresholds, everything becomes more expensive. It's just more financial burden for your not for profit. If it's necessary, then of course, if it meets a business need or a requirement, absolutely do it. But if you don't need it or it's not quite required, maybe work on doing really good cash accounting and prepare for the time when your organization grows to the point where it's going to need the full on accrual setup going. The other thing of note here is that, and I just put this in for the other federal regulators, the only other federal requirement is that if you're receiving federal grants of over a million, you have to hit accrual accounting. And you'll notice in here, I'm interspersing accrual and audit because that's when you're going to require accrual accounting is when you need to have an audit done. Once you need to have an audit done, you're going to be required to be on GAAP or accrual accounting. So these are all for audit. This is audit requirements are accrual requirements. Now, for the clients that we do have that are on accrual, we have methods and methodologies to show that we can make that very efficient and very organized as well. It doesn't have to be insurmountably expensive. You can definitely get it done for reasonable costs, especially if you get very organized and follow a lot of order within your accounting systems. So, thank you for taking the time to go through this with us. There's going to be just a brief quiz at the end of this, a few questions. We put those quizzes in there because this objective of this is to turn it into a full comprehensive course and to have a learning knowledge piece there. If you have any questions for us, please feel free to reach out at this contact information. Thank you.